Hello and welcome to this Lunar Quarterly Update. Certainly been an eventful second quarter. Right at the beginning of the quarter, you saw an announcement by Donald Trump on tariffs. You've seen the US make strides in ending the war in Ukraine, although that's still clearly going on. You've seen a massive European fiscal stimulus plan from Germany of 500 billion euros. You've seen interest rate cuts in the UK. And we're going to go through that today and what the impact has been on markets because it's certainly been a more volatile quarter compared to previous quarters. So we'll start with the UK. And one of the other big developments during the quarter was the conflict escalating again between Israel and Iran, and there was certainly some concerns that was going to impact the Straits of Hormuz, where 20 to 25% of global crude oil and liquefied natural gas passes through. So there was a real concern that would lead to a spike in commodity prices. And that's relevant because we've been here before. So this chart goes back to 2022 and it shows the impact that the increase in commodity prices had when Russia invaded the Ukraine. And that's really represented by this grey and lime bars here. That's the electric and gas and liquid fuels. And you can see that they added 4% to inflation in 2022. And as we come to today, inflation in the UK is running at 3.4%. That's CPI. So a 4% increase, if it's a similar event, would have a significant impact on potentially interest rates and the cost of living that we go through. Thankfully, as the quarter came to an end, it was only a 12-day conflict. A ceasefire has been signed, so the oil price has fallen back lower again. So again, in the short term, it does like it's going to be slightly more positive on the inflationary output. But 3.4% is still quite high for the UK. So the Bank of England do have an inflation target of 2%. So you can see that we are 1.4% above that inflationary target in the UK at the moment. Some of that is known. We knew coming into April and May that you'd see the impact of the budget come through in terms of increase to national insurance contributions from employers and increases in wages as well that were announced. And there's always the additional increase of rail, electricity, etc., which came through in April as well. So it was expected that inflation would pop up to these levels. So it's not really a concern. And 3.4% is still significantly below the 11% level that we got to in 2022. So inflation's running a little bit higher. As we look forward, we're expecting it to come back down. Economic growth's been slightly weaker, and that should bring prices down over the coming months. And as I said, the real impact of inflation being high is the moves that the central bank have to make in terms of interest rates. And this chart goes back to 2022, and you can see that interest rates between 2002 and 2007 ranged between 4 and 6%. We then had the financial crisis where interest rates were kept incredibly low for an extended period of time, almost 15 years of interest rates being at 0.5%. Obviously, there's a few moves around COVID and a few increases, but not major, compared to what you saw in 2022 when the Bank of England were really trying to bring this inflation down lower and increased interest rates to 5.25%. Where we are today is we've seen 4 cuts now of 0.25%. So interest rates are down to 4.25%. And the language from the Bank of England suggests that they're going to continue to cut gradually. So the way that we interpret that is probably once a quarter. So August and November look very likely to see further cuts in interest rates, particularly if inflation's coming back to more normal levels. So that's our view as we're looking out to the rest of the year. And that has an impact because it impacts the cost of finances, cost of debt, mortgages, etc. So that could help stimulate the economy as we go into the second half of the year. As I mentioned, the big development during the quarter was Donald Trump's introduction of tariffs, which we saw in his first time when he was president in the US. So we just thought we'd just explain what tariffs are. So they're taxes imposed by governments on imported goods. Why is this happening? Well, it's quite clear that Donald Trump wants more goods to be made within the US. It's also a revenue source for the US because it's money going into to the government, and the US does have significant amounts of government debt. So it's a way of trying to bring down government debt to a certain extent, and maybe that will be offset by spending cuts in the US, which could stimulate the US economy as well. There's the big beautiful bill going through at the moment, which is a number of tax cuts to the American population to really try and stimulate the economy there. What's the impact? Well, the impact is if you're increasing the price of something, then that's going to be inflationary. And it's also created a lot of uncertainty on supply chains and business confidence. We'll touch on that in a second, but that's been the major impact that we've seen over the last few months or so when tariffs have been introduced. And I've got a useful chart on this later, which we'll show. What are tariffs? This chart goes all the way back to 1790, and you can see the average effective tariff rate in the US going back then. And I wasn't around in 1820, but it peaked at 57% tariff rates. And you can see for the last 100 or so years, they've been on a downward trajectory. So in the 1930s at 25%, but really low at that 2% level. What Donald Trump announced initially was that tariff rates would get to about 20%. But the 90-day pause and the reduction in tariffs on countries like China, etc., and the trade agreements that the UK and Vietnam have done suggest we're probably more going to that 10% or so level. So without a shadow of a doubt, things are going to be more expensive in the US, which is going to impact the US consumer because tariffs are only going one way. You've seen that with the UK trade agreement, that there are certain sectors that have been excluded, but tariffs are increasing. Why are America targeting the countries that they are? China, European Union, Mexico, and Canada. This looks at the trade balance. So if there's more goods shipped into the US than the US is shipping out, and you can see those countries there have massive trade deficits with the US. So they're sending significant amount of goods over to the US. Now, the UK, right over here on the right-hand side, actually has a very small trade surplus with the US in terms of we're importing more of those goods. Now, I've touched on it already. The announcement and the scoreboard was significant, and it was very comprehensive as well. We note that the Heard and McDonald Islands, which has a population of 0 and is inhabited by penguins, are going to have a tariff rate put on them as well. So something to be mindful of. And again, we have to laugh at certain times like this as well. You can see the increase in the Make America Great Again hat from $50 to $77 because it's made in China. And the tariffs on China were significant. You saw them potentially at one point going up to 145%. So that was significant. What's happened since these announcements were made? You've seen a 90-day pause with most global nations. That actually is due to expire at the beginning of July. So we'll wait and see what happens next. Will that be further delayed? Will you see more tariff agreements? And then you've also got the 90-day pause with China. And it was those events that really drove markets. And I'll highlight that shortly in a chart. And what I mentioned earlier, that what tariffs do is they impact both inflation and economic growth. And I think this is our favorite chart of trying to explain the impact that those two measures can have. So on the x-axis going across here, you can see the impact that's going to have on inflation. So if we got to full reciprocal tariffs, it was going to add roughly 3.5% to inflation. And on this y-axis here, it's the impact to economic growth. And you can see if we did see full tariffs come through, then it was going to potentially hit the US economy by just over 2%. This is what panicked markets at the beginning of April because they were concerned about the inflation impact and potentially tipping the US economy slightly into recession. The US economy grows by about 3%. So just a 2% weighting, 2% hit to economic growth but from tariffs was going to move that very close to recessionary levels. Those 90-day pauses and the trade agreements that have come through is effectively taking us from the bottom right here up to the top left. So you can see that the market got more comfortable after the announcements were being made because it led to a less negative impact on economic growth and a smaller increase to inflation. And effectively, that's what Donald Trump's done. He's rolled back on the announcement and moving from the bottom right to the top left. So that's why you see markets stage a big recovery in May and June. And if you're a business in the US and suddenly you're importing goods from China and it's increased by 145%, then that's going to make things significantly difficult for you. And you've really seen this come through in both in CapEx intentions, which is the purple line here, going back to 2016, but also optimism, which is the grey line there. And you can see both measures have completely collapsed this year. When Donald Trump was elected in November last year, there was a real boost to optimism from businesses because he was seen as a pro-business friendly president. But the announcements have really made things difficult. And if you're based in the US and you want to build a new factory, then that creates uncertainty. You're going to build a new factory in the US, you're going to build a new factory elsewhere. What's the cost of that going to be? So it's really led to businesses sitting on their hands, and consumers as well were really impacted by this. So certainly hit economic growth, and that's really highlighted on this left-hand chart here. You can see what economic growth was on 2024 on the left-hand side in those grey bars, and then you've got the impact, the expected economic growth in 2025 in those purple bars. And yes, China has been impacted by the potential tariff announcements, and you can see that economic growth is expected to grow by more 4.5% this year than 5%. But the real impact has been the US, and you can see there that US economic growth was just under 3% last year, and it's going to be more like 1.5% because of the impact. Economic growth is always announced with a bit of a delay. So what we look as well is at these purchaser managed indices, which is those three lines in the right-hand chart. You can see the US in grey, Europe in purple, and the UK in that light blue colour. And again, you can see those lines really start to drift towards that 50 line, which means they're just expanding. So economic growth in real terms is getting a little bit of an impact from the announcements that have come through. So let's take a step back and just look at the equity market. So this is just the second quarter. So from the end of March to the end of June, we've got the most major markets on here. We've got the S&P 500 in dark blue, our very own FTSE All-Share in maroon, the Japanese stock market, the Nikkei 225 in yellow, MSCI Europe, European equity markets, the NASDAQ, which is the technology market in the US, and the Chinese stock market based in Hong Kong, the Hang Seng. And you can see right at the beginning of this chart, markets were down anywhere between 10 to 15% very early on in April on the back of tariffs. And what happened is you've seen a big relief as these pauses have come through and investors have got more optimistic that things can improve going forward. So, most major markets delivered positive returns, the Hang Seng being the only negative one there. These returns are also in sterling. And I think the other important point to mention is it's not just the equity markets which was impacted during the tariff announcement. There's been a concern of just investing in the US in general, whether it be US bonds or the US dollar as well. So the US dollar this year, relative to the pound, has moved from $124 to $135 at the beginning of July and end of June. That's about a 10% move in 6 months. That's pretty significant. And when we're investing in the US, when we're buying Apple or Microsoft, for example, we are doing so by buying a dollar. So we've had a currency depreciation of around 10%, which has impacted the returns to UK investors. So there's a lot of talk at the moment about the S&P and the NASDAQ 100 being back to all-time highs from the recovery, but it's not slightly there yet from a UK perspective because of the weakening currency. You can see there that the NASDAQ was a very strong performer in the quarter, up nearly 11%. Japan was up 11%. Europe was up 4 and 5%. So decent returns for what has been a very volatile quarter because of tariff announcements. And I think this is just something we want to reflect on as well. And we see periods of volatility on a regular basis in markets because events happen on a regular basis. And what this chart does, it goes back to 1986, and the red dots represent the worst intra-year decline. So what was the maximum fall during that year? And you can see, I think, first of all, that there's red dots in every year. There's always a correction or a fall in markets on any annual year. Some of them are bigger than others. You've got the financial crisis there, which is in 2008, where the market was down, this is a FTSE All-Share, by 43% at the worst point. What the grey bars represent, well, what was the actual return for the year? So again, sticking to that year, that it was a very poor year for investment markets when the FTSE All-Share was down 33%. But the average of those red dots comes out at around 15%. So a 15% fall in markets is very common for on a particular year. When we look at this year, it's at 13%. So the fall that we've seen already this year is average. So it's not something to be overly concerned about. This type of volatility is very normal. And you can see there right at the end of that chart that the market still delivered a positive return of 7% already year to date, and this is to the end of June. The other important point to mention here as well is that the grey bars tend to be positive more often than negative, because markets tend to go up slowly but then fall very sharply. So bear markets tend to, on average, only normally really be a year. The exception to that being the tech bubble, which was here in early 2000, when you have 3 consecutive years of the market being negative. But normally it's only on a single annual year basis. In COVID here, you can see that the market was down nearly a third at one point, but ended up the year slightly down at 12%. And as the economy reopened, you had a strong bounce back. So volatility in markets is very normal. What we've witnessed this year, it feels uncomfortable to go through at the time, but it's perfectly normal within normal expectations. And just to highlight this as well, so this looks at a balanced portfolio, so 60% invested in equities and 40% in bonds. What's happened after the shock has happened? So when all the concerns have been, you've got the return after 1 year in grey, and you've got the various different shocks there, and then you've got the 3-year return in blue. And as I said, we've seen this for a number of times over the years, whether it be the Gulf War, we've got the financial crisis in here, you've got 9/11, you've got the European debt crisis, you've got the COVID pandemic, you've got Brexit in there. And you can see here that on average, if you look at that very end right-hand bars, a year after the event, a balanced portfolio tends to be up by just under 10%. If you're looking a bit further out and 3 years on, then markets tend to be up just over 20%. So you can make decent returns or significant returns by investing at the bottom of these concerns, because markets move very quickly to discount the bad news, but then recover. And sometimes it's darkest just before it's dawn with markets. And just to highlight that, during the during the COVID pandemic, the lower the market was the 24th of March. That was also the day that Boris Johnson announced that we're going into a national lockdown. Now, you really wouldn't expect the market to be at a bottom then. We didn't get the vaccine until November 2020. But the reason it was is because markets are forward looking. And as soon as we were put into a national lockdown, markets were thinking, well, when are restrictions going to be lifted? When is the economy going to get back to normal again? So markets look forward by roughly 6 to 9 months about what's going on with the economy. So just to summarise then, the US and UK are very much at risk of stagnating. Economic growth in the UK is probably about 1%, as highlighted on that chart. And we do have stickier inflation in the UK. Tariffs certainly have the same impact on the US economy, which has already been mentioned in terms of economic growth being weaker and inflation being higher. And whether we like it or not, what's going on with the US economy really matters to the UK stock market and UK investing, because we buy US companies, and a lot of the companies listed in the UK sell to the US as well. So it does have an impact. We've seen economic growth slow this year because of tariffs and the uncertainty that creates. Policies created by Trump create uncertainty, but they also create opportunities. I mean, if we had the full aspect of hindsight, then at the 8th and 9th of April was a great time to be investing, because the market had priced in a lot of the bad news, and then you had the announcements of the delays, and equity markets have delivered very good returns since then. As we touched on, interest rates are likely to come down gradually, and why we mean that is by 1.25%. And we think we'll probably settle at kind of 3 to 3.5% for UK interest rates. So still room for some cuts within the UK. And when investing, please don't do so for the short term, because it's volatile. When investing, it's always better to take a longer term view. And try to highlight with some of the charts there, because markets do tend to be more positive than negative over the long term. Thank you for listening today. If you do have any questions on that, or you want to know our views in any more detail, then